So, today we're taking you from an overwhelmed, maybe even stressed out homebuyer and transforming you into a totally empowered homeowner. You know, the mortgage process, it can feel incredibly daunting, right? It's packed with confusing jargon, massive numbers, and just seemingly endless paperwork. But don't worry, we're going to map out this entire financial journey together, step by step, so you know exactly what to expect. Let's dive right in.
Here's our roadmap for today. We'll start with preparing for homeownership, move on to choosing your mortgage, break down amortization and costs, navigate that tricky mortgage insurance, and finally, wrap up with your rights and options.
All right, Section 1, Preparing for Homeownership.
Listen, before you even step foot into an open house or even look at a single property online, you've really got to build your foundational training ground. And the biggest secret in real estate, you do not have to do this alone. As HUD-certified housing counselor Loretta Kale points out, a counselor is literally a free team member who understands exactly what you're going through. And they aren't there to judge you. They're just there to help with things like budgeting, credit repair, and even finding local down payment assistance programs so you can genuinely be the smartest person at the closing table.
But hey, if you're someone who prefers to learn on your own, there are some absolutely phenomenal resources out there. Programs like Freddie Mac's Credit Smart are incredible, free tools that you can just use at your own pace. We're talking 48 micro-modules spread over 6 to 8 hours, all designed to help you master budgeting, saving, and the basics of credit. It is a fantastic way to build up your financial capability right from the comfort of your couch.
Moving right along to Section 2, Choosing Your Mortgage.
Okay, so once you're prepared and your credit is looking good, we have to navigate the alphabet soup of loan options. It can seem like a lot, but you essentially have two main paths. On one side, we have FHA loans, which are insured by the Federal Housing Administration. Now, these are incredibly helpful because they offer much lower credit score thresholds. Then, on the other side, we've got conventional loans. These conform to Fannie Mae and Freddie Mac guidelines. They generally require slightly higher credit scores, but here's the kicker. If you can put down 20%, you completely avoid paying extra for mortgage insurance altogether.
Now, I want to take a quick pause and sound a bit of a cautionary alarm here. Despite what you might see in those flashy internet ads, the federal government does not offer free money to individuals to buy a home. No way. Those ads are very often just straight-up scams. So when you're looking for assistance, always rely on official resources. Start with your state housing finance agency to find legitimate mortgage assistance programs.
All right, let's get into Section 3, Understanding Amortization and Costs.
So, now that we've theoretically picked a loan, let's pull back the curtain on the actual mechanics of the thing. Like, where exactly does your money go every single month? The absolutely crucial concept you need to grasp here is amortization. I want you to think of it like a giant financial seesaw. At the very start of your loan, your overall balance is high, so your monthly payments are heavily weighted toward paying the bank's interest. But as the years go by, that seesaw starts to shift. By the end of your loan term, your payments are almost entirely tackling the actual money you borrowed, your principal.
And this is exactly why the Consumer Financial Protection Bureau warns that because of this amortization process, the actual equity you build up early on is much less than the sum of all those monthly payments combined. Because of the seesaw, that interest takes a massive bite out of your payment in those first few years.
Plus, your actual monthly payment isn't just one big bucket of money going to the bank. It's typically divided into 4 distinct parts: principal, interest, taxes, and insurance. And that's exactly why your total monthly outlay is often quite a bit higher than just the math on the loan itself. Those property taxes and homeowners insurance premiums, they're rolled right into that single payment through what's called an escrow account.
Next up, Section 4, Navigating Mortgage Insurance.
Okay, if you bought your home by putting down less than 20%, you're going to encounter a major trap you need to watch out for: mortgage insurance. First rule of thumb, this insurance protects the lender, not you. If you have borrower-paid MI, it's an extra monthly fee, but the good news is it can eventually be removed. But man, watch out for lender-paid MI. It sounds awesome at first because the lender pays the fee up front, but in exchange, they give you a higher interest rate. And the catch? You are locked into that higher rate for the entire life of the loan.
So if you do have borrower-paid mortgage insurance, your goal is to get rid of it as soon as humanly possible. And under the Homeowners Protection Act of 1998, you can actually take back control here. Once your loan balance drops to 80% of the home's original value, assuming you have a solid payment history, you can aggressively initiate its removal. You literally just make a written request to your servicer, and often you just provide a new appraisal to prove the home's value hasn't dropped.
But hold on a second.
Before you decide to just throw a massive lump sum of cash at your principal to hit that 80% mark and drop your PMI, make sure your loan documents don't hit you with a prepayment penalty. Yes, that's a real thing. It's a fee some lenders charge if you pay off too much of the loan way too early, usually within the first 3 to 5 years.
Now, as the CFPB advises, these penalties don't normally apply if you're just adding small, extra chunks of principal to your monthly payment. But if you're planning on dropping a huge sum all at once, always double-check the fine print. Specifically, you want to look for something called the addendum to the note in your closing paperwork.
And that brings us to Section 5, your rights and options. We've finally reached the climax of your journey, exercising your federal rights as a borrower. Yes, you have rights, and lenders have very strict rules they must follow. But first, you have to understand who you're actually dealing with. The company collecting your monthly payments is called your mortgage servicer. And honestly, quite often, this servicer might not even be the actual bank or financial institution you originally sat down and signed your mortgage with. Loans get sold all the time, but the great news is your federal protections travel right along with them.
The CFPB requires your servicer to play by some incredibly strict rules. For example, they absolutely must credit your full payments on the exact day they are received. They also have to give you a 45-day warning before forcing expensive, force-placed insurance onto your account. If you spot a mistake and send them a written notice of error, they have a dedicated process to resolve it, and they can't charge you fees for that. Oh, and if you ask for a payoff quote, they generally have to get it back to you within 7 business days.
Okay, so what if you're stuck with a really high interest rate, or worse, you're trapped in that lender-paid mortgage insurance we talked about earlier? Well, refinancing might be your escape hatch. But before you pull that lever, ask yourself these crucial CFPB questions. Are you planning to move soon? Because if you are, you might not even recoup the closing costs of the refinance. Also, has the value of your home fallen? If it has, finding a favorable new loan might actually be pretty tough.
Look at that! By breaking down this timeline today, you officially moved from being intimidated by the paperwork to being fully equipped and ready. You know exactly how to access free HUD counseling, you understand how that amortization seesaw actually works, and you know exactly what your federal rights are when dealing with your loan servicer. You're empowered.
And I'll leave you with this final, pretty exciting thought to check on your own mortgage statement. If you understand amortization, you know that early extra payments are incredibly powerful. So how much of your hard-earned money could you save, and how many years could you instantly shave off your loan simply by taking control and throwing an extra $100 toward your principal today? Go grab your statement and find out. Thanks for joining me on this explainer.